We all hear about inflation. Prices are going up, but that is really just the beginning of the story. The more interesting question is what actually happens after prices rise and where the extra money goes when you pay more for something. To understand that, we need to follow the dollar itself. It's a strange feeling that many people recognize. You might get a raise at work and see a bigger number on your paycheck, yet at the grocery store or the gas station, that extra money seems to disappear. Your budget feels tighter than before, even though, on paper, you're earning more than you used to. That tension is the central puzzle here. When prices rise, your money does not vanish into thin air. It moves quietly and unevenly, often in ways that are not obvious at first glance. To make sense of inflation, we have to trace where those dollars actually end up. The first idea to get clear is a simple but important one. During inflation, money does not disappear, it gets reallocated. Inflation is not a force that destroys dollars, it's a system that changes who receives them. Every time you pay a higher price, money is shifting from one place to another. It moves from consumers to businesses, from people who hold cash to those who issue debt, and from households to institutions. Your dollar still exists, it's just sitting in someone else's account. The journey usually begins far up the supply chain. Long before a product reaches you, the company producing it is dealing with higher costs for materials, energy, transportation, and labor. Those costs build on each other and eventually show up in the final price you see. When you pay more for an everyday item, you're not simply giving extra money to the store. You're covering higher fuel costs, higher utility bills, and higher input prices throughout the production process. Each of those increases is folded quietly into the price you pay. Some of that extra money does flow to workers in the form of higher wages, but this adjustment tends to happen slowly. Prices can rise quickly, but wages usually respond with a delay. That gap is why inflation often feels painful, because higher prices arrive before higher income does. During that period, households are effectively paying today's prices with yesterday's pay. Even if wages eventually catch up, the timing mismatch creates pressure in the meantime. That pressure is one of the most common ways people experience inflation in daily life. There are also less visible channels where money is redirected. One of the largest is interest. When inflation rises, interest rates often rise as well, making borrowing more expensive across the economy. As rates increase, a larger share of household income is automatically routed towards interest payments on mortgages, auto loans, and credit cards. That money doesn't disappear, it becomes income for lenders. At the same time, it leaves less room in household budgets for saving or discretionary spending. Interest is essentially the price of using money over time. When that price rises, it changes the math behind many financial decisions, from buying a home to managing everyday cash flow. Inflation doesn't just raise prices, it raises the cost of time. Taxes are another quiet channel of redistribution. If income rises just enough to keep pace with inflation, higher nominal earnings can push households into higher tax brackets. This process, often called bracket creep, can increase tax payments even when purchasing power has not improved. The result is that inflation can raise government revenues automatically without any new policy changes. Once again, purchasing power is transferred rather than destroyed. These shifts don't affect everyone equally. Households on fixed incomes, people holding large amounts of cash, and renters often feel inflation most directly. Their costs rise while their income or protection adjusts slowly or not at all. Others are more insulated. Asset owners may see the value of real estate or stocks rise with inflation, and borrowers with fixed-rate loans can benefit by repaying debt with dollars that are worth less over time. Inflation reshuffles financial outcomes depending on what people own and owe. When essential costs like housing, food, energy, and insurance all rise together, the effect can feel overwhelming. More of each paycheck is claimed immediately, leaving less flexibility for saving or planning. This sense of pressure is not imaginary. It reflects a real compression in household finances. Seeing inflation clearly means moving beyond headline percentages. It means recognizing inflation as a system of transfers that quietly redirects money throughout the economy. That understanding doesn't make inflation painless, but it does make it easier to interpret. The goal is not to create fear or predict what comes next. It's to provide a clearer map of how money moves when prices rise. Once the map becomes legible, navigating the terrain becomes more intentional and less confusing. This content is provided for educational and informational purposes only and should not be considered financial advice. It does not take into account individual circumstances, and viewers should conduct their own research or consult a qualified professional before making financial decisions.